Good afternoon. Welcome, everyone. I am so thrilled to be here today for our live chat with David Chilton, author of the recently re-released personal finance guide, The Wealthy Barber. For over 35 years, Chilton, a former dragon on Dragon's Den, has helped millions of Canadians manage their money through approachable, actionable finance advice. Originally published in 1989, the book sold 2 million copies in Canada. Chilton has updated the book for the new generation with fresh advice on how to use the latest personal finance tools, including TFSAs, FHSAs, ETFs, and more. We're joined by hundreds of attendees this afternoon, and we are thrilled to be speaking with David. Welcome, David.
Hey, thank you so much for having me on. I'm looking forward to it. I was saying to you off air, I'm in the snowstorm down in Waterloo, just by the St. Jacobs Market. We've got maybe 30, 40 hours to do this interview because I can't go anywhere. So just fire away. We can go on as long as you want. No, this is going to be fun. I'm excited about this.
Me too. Yeah, settle in, everyone. Get cozy, grab your coffees or your hot chocolates. And we're going to get right into it here. So, to kick things off, David, I wanted to ask you what motivated you to update The Wealthy Barber for a new generation?
When I answer this, people think I'm kidding, but I'm not. Some of it was I better do it now because I don't have much longer to go. I'm getting up there. I'm 64. And so I thought I better get on top of it because I've always thought about coming back at it. But the big thing was my kids, they're in the target demographic, they're in their early 30s, and the book's really written for kind of 20 to 45. They were asking a lot of the questions that I, of course, heard all those years ago, but for their current times and reflecting the changes. And so were their friends, and so were my friends' kids, et cetera. And I thought, let's take a look at this. I did some pre-writing research and thought there was a good opportunity. There's so much noise out there, so much information. Can we put it all in a form that people enjoy reading, that they can learn from along with the characters? And that's where the idea started. I thought it would be a relatively quick process. It took me longer to write the rewrite than it did to write the original. There's more products now, there's more challenges now, but so far so good. It's going over very, very well.
That's great. It really is packed with very useful advice. If anyone out there doesn't have it yet, go get your copy. You don't want to miss this really, really great advice. So, David, we're going to get into our reader questions.
Great.
Our first question today is from Dawn D. And her question is kind of piggybacking off of my last question, which is how has the management of personal finance changed over the years since the first edition of The Wealthy Barber?
I'd group the changes into three categories. On a positive note, there are more products. You mentioned FHSAs, the accounts like that, the TFSA that really can be a big help for people. Let's just go with the FHSA. You get the tax deduction up front when you contribute to it, the first home savings account. The money comes out if you're using it to buy the home on a tax-free basis. Wow, that's the best of all worlds. You've had other products come in like ETFs, exchange traded funds, that are very, very inexpensive ways to gain access to the equity market. But on the negative front, the cost of living is quite high. And real estate in particular, obviously, that's problematic for a lot of young people. Putting together the down payment, the fact it drains their cash flow, that makes all of this trickier. It's basic arithmetic. And then I would argue psychologically, it's more challenging now to apply the Wealthy Barber's advice than it was all those decades ago, because of course we've got social media, we've got the algorithms, we've got AI, and everybody's become so adept out there at patterning our weaknesses and getting at them, targeting them extremely effectively. And now we have no friction between the temptation to buy and the buying. We can one tap, we can one click. And so from a lot of perspectives, I think it's tougher now than it was back in 1989 when the book first came out.
Yeah, that's great. And I think will probably help a lot of people feel a little bit better that, it's not just them. Um, that also kind of leads into the next question, the fact that things have changed so much and there is so much noise out there. There are a lot of people who are so stressed about money that they just don't want to think about it. And then of course that can make it worse. So what advice do you have for folks to help them get over that mental money block? That question is from Isabel S.
Well, honestly, I'm not giving this as a motivational, corny answer. This is truly from the heart. It's why I wrote the book all those years ago. This stuff is not that tricky. Interestingly, in personal finance, the complicated stuff, and there's lots of it, doesn't work. It maybe works for the seller, but it doesn't work for the investor. For the most part, good principles are very easy to grasp. And that's really what the Wealthy Barber was all about those decades ago. And now is saying you can grasp these. Here are the 5, 6, 7 concepts you need to understand. There's nothing that tricky. They're not that math heavy. They're not that complex. Let's walk through them with the characters asking the questions a normal person would ask. And so that's, again, sounds corny and motivational, but I mean it from the heart. You can do this. You can understand it. Now, of course, implementing it it's tricky still because you've got human nature sabotaging you and you've got this high cost of living I mentioned, but you can understand it. There's ways to get going. You must take first steps. I mean, that's the absolute crucial thing. I find with a lot of the younger people I've helped over the years, I just get them to do one thing first. So let's put some money into the group RSP and take advantage of the matching. Let's pay down the credit card debt more quickly than we were. Just that first step tends to engage them, make them see the possibilities, and we go from there.
That's great. I love the characters in the book. I think my favorite is Kyle.
Good. Yeah, he's a bit of a smart aleck, but thank you.
Yeah, I think that's why I like him. You know, it's a little bit more
For sure.
realistic.
Exactly.
Um, some questions from folks around advice for young people who are kind of getting started on their financial journeys. Deanna P is asking, what is your best advice for a young person who's starting from the beginning, who's, they're paying off student loans, they don't have much savings? Would you say it's more important for them to start immediately contributing to an RRSP, or should they grow their personal savings and pay off loans first?
It's an interesting question. It's one of the most common questions in the country is, do I go at my debts or do I start building up an RSP or a TFSA? A lot of it, by the way, depends on the interest rate of the debt. So if, for example, you have credit card debt and it's 20, 21, 22%, for heaven's sakes, focus on that. That's your after-tax rate of return that you're earning. By paying it down, you're also reducing stress, freeing up cash flow. You can't screw it up. It's an after-tax return. That's an all-good move. It's almost always your best first move. I mentioned a few moments ago, putting money into your group RSP when your company matches the contribution. That's normally your best mathematical move. So paying down credit card debt, very good move. Student loans, obviously a lower interest rate, often around the 6% area, still not a bad move. Paying off that debt again reduces stress, frees up cash flow for later, makes it easier to qualify for a mortgage. One of the things I love about focusing off paying off debt when you're young and first entering the workforce is it makes you spend less than you are earning. You have to, because you're putting some of those earnings towards the debt pay down, whether it's student debt or credit card debt you've rung up, et cetera. So I think those are all very good moves. I think in many instances, you can focus on that before you start building up the retirement savings, the TFSAs. All that being said, very interestingly, when you study the people who've handled their money well over the years, a lot of them, unless it's high interest debt, have gone the opposite route. They've said, I need to build the savings habit. I need to get the money in early and start taking advantage of compounding. I believe if I dollar cost average into the markets, I can average 7, 8, 9% over extended time frames. So I'm going to go that route, but I'm also going to try to focus on nipping away at that debt at a faster than requested pace. So striking a balance is sometimes a good move, but again, the interest rate on the debt is a big part of the determining factor.
That's great. Very helpful too. I think there's a lot of young folks who are struggling with debt and trying to save at the same time.
Well, the student debts now, compared to when I came out all those years ago, our tuition was so inexpensive. A lot of people went to school locally, a higher percentage, et cetera. Now we're seeing, again, more post-secondary degrees that involved people going back for masters and PhDs, et cetera. Often a very good investment, but people are coming out with much heavier student debt, not to the American levels, albeit, but still, it's a challenge in Canada. And when you're coming out with that student debt into such a high cost of living environment right now, it does make it tricky, and it's very stressful for a lot of young people carrying all that. So, I mean, I wish that I had an easy answer, but at least the question has it right. Do I go one of those two paths? Definitely go one of those two paths. Like, you want to pay down the debt as quickly as possible or start building up your retirement savings. You want to tackle something as opposed to just spending everything you make.
Right. Yeah, at least do something, I think is at least one of the best takeaways from this conversation is just to get started, right? We're going to pivot a little bit now to talk about housing. So, homeownership is still a goal for a lot of young Canadians. So, for a young Canadian who is prioritizing retirement savings, how can they also save for a down payment on a house? Is it okay for them to lower their ongoing retirement contributions temporarily so that they can put more towards their down payment? That question is from Daniel K.
Daniel, yeah, you've nailed the big question of the day for so many young people is, Dave, come on, you can read The Wealthy Barber, but can I really do all of that? Can I really set aside 10 to 15% for long-term growth and build a down payment and get to the required level? Probably not for most people. So you are bang on and saying you have to prioritize, you have to feel your way there. The characters in the book dealt with that exact conundrum. and the two who didn't own a home yet decided to build a down payment fund first. I think a lot of boomers have lost touch with how hard it is to build the down payments nowadays. I mean, you've had home prices rise at a 2.5 to 3 times the pace of incomes over the last 30 to 35 years. If you're looking in Toronto, for example, a starter home can run $700,000. If you're trying to hit the 20% down payment mark to avoid the mortgage insurance, that's $140,000. Do you know how hard it is to save $140,000 after tax? Even if you're a couple, even if you have a fairly good income. So you almost have to prioritize to that if getting into the housing market is so important to you, and then play some catch up on the retirement vehicles. Again, there's no perfect answer here because of the cost of things. We can't do it all, but very good question, and a question that, again, a lot of people need an answer to.
That's great. Uh, Moving on to some investment questions. Always lots of investment questions. This one is a great question. This is from Annie K. And she's asking, how can someone effectively use RRSPs and TFSAs to get the maximum benefits? I think there's a lot of misconceptions here, so I'm excited for your answer for this, David.
Yeah, this is a tricky answer. I just spent several pages on this in the book because, again, we go back to the previous question. People can't do it all. And so it's great for a financial advisor to say, Max, both your TFSA and your RSP. Are you kidding? The vast majority of people can't do that. So if you can only do one, where's your priority? Well, lately, the TFSA has picked up a lot of steam. If you watch TikTok and YouTube and even some of the better financial advisors, they say, oh, the TFSA is simpler, it grows tax-free. It's not always your best first bet. It's tricky. It actually comes down to your marginal tax bracket at time of contribution to the RSP versus what you think it's going to be at time you withdraw the money. And again, a little tough to explain in this environment, but I really want to drive home to people. You do have to do some research, whether it's reading The Wealthy Barber or going online, because what I'm seeing out there right now is a default position of I'm just going TFSA. That's not always the best bet. RSPs are actually taking a beating on the public relations front lately, and they don't deserve it. They are not perfect. On occasion, I would not use them, but for the most part, they still are a big help to people trying to build up wealth over the long term to help them in retirement. So don't buy into all of the criticism. Do some research. The Wealthy Barber will help you on that front for sure. They're both very good vehicles. Which one's better? A little tricky.
Right. Yeah, that's great. Let's talk a little bit about ETFs. Again, this is something that we see a lot on social media these days. There's a lot of buzz around them. How are ETFs different from regular stocks? And what is the easiest and most prudent way to start investing in them? That's from Corrado R.
The short names, last names of all these people are interesting. Everybody's got a very short last name. I like it. I'm kidding. It's funny because when I went to write The Wealthy Barber, to do the redo, I went out to the marketplace and did a lot of pre-writing research. And one of the things I did was I went to a local mall and I asked 20 adults, what does ETF stand for? What is an ETF? One person got it right. And so there's an assumption out there by a lot of the media and by a lot of the experts who are doing online videos that the public has a certain knowledge level that often proves not to be there. ETF stands for Exchange Traded Fund. Let's go with the last word, fund. It's a pool of capital that's put together by a number of investors and invested often in stocks. That's an equity ETF. It could be bonds, a bond to ETF. It could be a mixed ETF. It could even be an exotic ETF that invests in crazy things, alternative investments, but it's an exchange traded fund, meaning instead of buying and selling it from the fund company, you buy it over an exchange like you do a stock. Now, the question asks, what's the difference between that and an individual stock? Well, to some extent, self-explanatory. This is a fund. It's a pool of capital buying a wide variety of stocks. It could be an index fund, a related ETF where they're buying all the stocks that make up one of the well-known indices like the Standard & Poor's 500 or the S&P 60, or it could be an actively managed ETF. And then on the other hand, you can buy individual stocks. So you may want to buy stocks in companies you're familiar with or companies you've heard good things about. For the most part, the vast majority of people are better to go the route of the index ETF because it tends to outperform them trying to move in and out of stocks on their own. That's a very difficult thing to do and outperform. Now we're seeing the rising popularity of these all-in-one asset allocation ETFs, where you buy in sometimes on a monthly basis because people are setting aside monthly, and they gain access to this pool of capital that is buying stocks all over the world. You have geographical diversification. You have all of these different companies that make up the indices in the different countries throughout the world, and you have rebalancing. So whatever the predetermined allotment is to each country, they bring it back to that allotment periodically, which helps to force on them selling high and buying low. So a lot of those products are wonderful. They're relatively inexpensive. The expense ratios, what you pay to have this done, very low, doesn't affect your returns too much at all. And those products are really picking up a lot of steam right now, especially with, I find, younger investors.
Yeah, I personally am a big fan of the asset allocation ETF. I'm glad you mentioned that.
No, that's good. That's good.
Yeah, it's great. Um, okay, so this is probably something that's on a lot of people's minds here in Canada. The ongoing tensions between Canada and the US, considering tariffs, unpredictable GOP policies. Vince M is wondering, how should we take a look at how should we adjust our overall investment strategy considering these tensions between Canada and the US?
This answer is going to surprise, I think, people. For the most part, you shouldn't pay any attention to any of it. In fact, the better investors are oblivious to world events, political tensions, changing economic times. They tend to just focus very long term and then rebalance on occasion. They know they're not smart enough to harness all this information in a productive way. We go back to the time when it was announced that tariffs were going to hit, and we had that crazy day and the markets were crashing and people were panicking and getting out. And of course, they've rebounded for the most part quite nicely since then. Now, that being said, if you are an older investor, you are 60, 65, you're my age-ish, then maybe you want to be a little more cautious, not just because of the tensions out there, but also because markets are quite expensive. They are quite rich right now by almost any valuation criteria. So I've seen a lot of people say, hey, I've done well for an extended time frame. I'm actually a little ahead of where my projected numbers had me being. And therefore, I think I'll take a little more off the table on the equity front, but seek financial advice, deal with a competent professional when you're doing that. But again, going back to the big picture, market timing, trying to read all of this, harness it, put it into play, it's very difficult. People like my father, who is, I think, 141 years old now, if I'm not mistaken, he does none of that. He just leaves his money alone and he's prospered. He doesn't try to outguess the markets or watch all of the events. Let's be honest, who knows where all this is heading? I mean, it is an intimidating time. The world is very much on edge right now. We have so many hotspots politically and, of course, economically. Canada's being squeezed by the falling out of with the relationship in the US. I can see why people are guarded and why they maybe want to be a little bit more cautious. I'm noticing as I speak to people, a lot of people have said, I'm going to pay down my debt a little bit more quickly as opposed to going to the RSP, TFSA, et cetera. Going back to that first question, it's because of the political tensions and all the uncertainty, including AI. And they're saying what I'm trying to do is lower my burn rate. I'm trying to make sure that I've got my costs relatively low in case, there's a lot of negative fallout to all of this turmoil. Again, who knows? I tend to almost always be a long-term optimist, by the way, and to think that human ingenuity and creativity and our ability to innovate will carry us through, and there'll be all kinds of peaks and troughs and ups and downs and all arounds. But in the long run, that life will get better for most. That has always tended to be my philosophy. So far, that's served me very well. I hope it continues to.
Yeah, and there's some great advice in your book as well regarding, the pitfalls of trying to consistently keep your eye on the market 24/7. We have enough stress, right, David?
Absolutely. Absolutely. I wish I was smart enough to do it. Like, I do follow the markets very closely, but I don't trade them. I follow it all because I find it fascinating. Macroeconomics, the trends, the political issues, all of it. But I've never kidded myself that I can take all that knowledge and weave it into outperformance on the stock market front. I know better than that. I'm not that clever.
Clever, but not that clever.
I'm not even sure clever, to be honest, but certainly not that clever.
Let's talk a little bit about saving for retirement. We have a question here from Mike E, who was recently retired with a defined benefit pension. He has substantial savings in RRSP, TFSA, and non-registered accounts. So Mike is wondering how to prioritize withdrawals to minimize taxes and also leave an inheritance for his kids.
Well, first off, Mike, if you want to get married, call me. That seems like you're in a very, very good position here. I like it. Defined benefit pension plans, it doesn't get a whole lot better. I mean, they're fantastic. But I think your question is one of my favorite, and I'm so glad it came up in this event because you really need professional help. You really do. It is tricky figuring out the tax optimization approach to taking monies out from all these various accounts. Think of all the sources of income people have in retirement. They've got CPP, they've got OAS. In his case, he's got a defined benefit pension plan. They may have RSPs, they may have TFSAs. Mike mentioned he had non-registered accounts. We go on and on. You know what your income needs are, but where do you go to get it? Where do you get the capital out? Again, to optimize from a tax perspective, you need software. You need expertise guiding you there. Somebody has to work through what are your objectives? What do you think your forecasted spending is going to be? A very good point came up there. It's also important to him to leave a lot of money. For some people, it's not. And so everybody's in a different position, but you must have software. The industry, I'm going to be quite blunt here, was truly horrible at this 5 to 7 to 8 years ago. It really was. Very few people were getting proper advice on how best to do this. We've seen a significant improvement. It's not there yet, but we're seeing more and more financial advisors embrace the software, throw themselves into this. We're seeing a lot of specialists come out who now really know their stuff here. There's some amazing YouTube videos by a number of Canadians on how best to think all this through. But even when you understand all their points, you still need the software and the professional expertise to get you where you want to go. So that's the long-winded answer to this. It's a great question. Get help to get the answer that's right for you.
Great advice. Rosanna is wondering what she should do with an annual bonus of $10,000, which is a very exciting amount to
It
be
is.
blessed with. So she's wondering if she should take that and put it into an RRSP, or if she should use it to pay off a line of credit.
Okay, it's interesting. So a couple things. Let's say that she has a potential to use some of that money to take full advantage of the employer match with a group RSP. It may not be the case, but let's just say it is. That is a true no-brainer. Like oftentimes companies are saying, we'll match up to say 6% of your income when you contribute dollar for dollar. That's 100% return immediately. Like, are you kidding me? So if she has that opportunity and hasn't taken advantage of it, boy, what a great opportunity with that bonus. And of course, you're doing it with pre-tax dollars. If, on the other hand, that's not there, then she has to decide between the RSP, the TFSA, the paying down non-deductible debt, the things we've spoken about before, and make those same kinds of calculations. I would say we go back to the answer to question one, that if she has high interest rate debt, credit card debt, for example, she may be best to pay the tax on the bonus and pay down the high interest credit card debt. But again, remember, if she puts that money into an RSP that she qualifies for, she doesn't pay tax on it. It grows unencumbered by tax until it's withdrawn. Then, of course, you have to share with the CRA. So this is back to that balancing question between TFSA versus RSP, and then whichever one makes the most sense there, then compare it to paying down the non-deductible debt, which again, that part of this is interest rate sensitive. What I like about this is she's put toward the right options. She's not thinking spending it. She's not thinking of doing something crazy with it. She's not thinking of even investing it responsibly, but in a non-registered account. She's thinking of either paying down debt with it or going the RSP or TFSA. She's definitely on the right track.
Well, that's great, Rosanna. You're off to a good start. We have a question from Waverly B, who is a new parent. Very exciting. Waverly says, I just gave birth to my first child and set up recurring contributions to his RESP. Do you have any budgeting advice for new parents? They seem to have unexpected costs since his arrival. Surprise.
Yes, and those unexpected costs are never going to stop. Okay. You know, one thing about kids that's very annoying, they keep growing and needing new outfits and so on and so forth. So, I mean, kids are expensive, no doubt about it, but worth every penny. And so you do have to budget. You do have to learn to be very disciplined. On the RESP front, it's going to sound like I'm kidding, but I know I try to get the grandparents involved. Obviously, not always a possibility, but if it is, yank them in. Most of them are very happy to help out. They recognize that younger people, younger parents are under a lot of financial pressure now with the cost of shelter, the cost of food, etc. So if they can help out by making a true investment in the grandchild's future, if they can afford to, they're often eager. In terms of budgeting, you know, it's funny. I've never been as big a fan of budgeting as most financial educators. I don't think it's a useless experience to go through it and look at things. I'm a bigger fan of spending some, where instead you chronicle all your spending over the last couple of months, literally writing it all down. There are some apps out there that can help now. You see where the money's going. That leads to very, very wise adjustments in many cases that help you save more. You recognize where the leaks are. It helps you spend more efficiently too. You notice where you're spending money and not getting the commensurate joy units, all of that. But you'll normally see where you can free up some capital for things like the RESP. And then, of course, the other decision you're faced with, how do I invest this money? So I've got the monies inside the RESP. Well, this is a newborn. They are a long way away from going off to university, college, qualifying institution, and therefore you have a lot of time on your side, and therefore you may want to take on more risk. All those things have to be thought through. Again, I don't want to tell you what to do without knowing you specifically, but time is such an important part of all of the decision process here, and you may want to take on more risk with investing that money.
Yeah, that's great. Um, I think we'll get into some of our other questions here since we still have some time, which is wonderful. Uh, we want to know about mutual fund management fees. This is one thing that came up. This is from Jamie H. So we talked about ETFs, and you mentioned that there's relatively low costs involved. Jamie H, I guess, is just wondering overall, is it worth it to pay mutual fund management fees? What are the pros of this?
That's a good question. I like even the way that he phrased that, or she phrased it. Hard to know with Jamie, but it's an interesting question. I mean, the management fees in Canada are quite literally among the highest, if not the highest, in the world. We often see actively managed mutual funds, let's say equity funds, not bond funds, with fees of 2.1 to 2.4%. Doesn't sound like much because, as I said in the Wealthy Barber, we always refer back to school marks. So I got 92 or I got 58 or whatever. 1 to 2 to 3, that doesn't sound like a big number. But remember, if your expected return of the underlying investment is, let's say, 8% per year, that's your hope, and somebody's taking 2, that's 2 of 8, that's 25% of the expected return. Fees matter. In fact, all else being equal, unless you get outperformance by the active money manager, they can take away 25 to 30, even 35% in some instances of the retirement pool of capital you're building up. They really do make a big difference. The bottom line is all the research supports that it's very difficult for actively managed funds, professional mutual funds, to outperform the broad market averages, i.e. index funds. But even among the few who can, you have to be able to pick them ahead of time. How do you research this and figure it out so you know, yeah, that's the 1 in 10 that's going to do it over the next 10 to 15 years? I wish I was that sharp. Heaven knows I've tried. A lot of smarter people than I have tried. A lot of computer models have tried. Nobody's been able to do it. So my argument over the last 20 years has become you're probably best just to buy the low-cost index fund and keep those fees down, keep the money in your own back pocket. Now, that doesn't mean you don't want to end up paying for financial advice at various times in your life. You may still buy the index funds, but you may pay an asset manager 1% a year because that person is providing you not just with investment advice, you're going the index fund route, but also with estate planning advice, insurance needs analysis, all types of things that can add a lot of value to your life. So every scenario is different. But again, for most people, I think it's kind of been proven that the actively managed mutual funds are probably going to add negative value.
That's great. And I'm glad that you mentioned the professional advice aspect because it kind of leads directly into our next question from Craig C. He's wondering what is the best way to find a reliable, trustworthy, I think is the key word here, fee for service financial advisor?
Well, I have to tell you a couple of things. First off, the financial planning industry, I'm impressed. In the investment advice industry, lately, I've seen so much good work. Holy smokes, it's easy to be critical. A lot of times people sit back and go, wow, I've seen some very biased work or not very well done work. And you certainly still see some of that. But there are some young stars in this industry now. And what's interesting is they're starting to come together and they're communicating all over all these platforms. And then more people are getting drawn into it. And you can see this sounds corny, but the passion to help people, you really can. Like, I am so impressed with some of the people that I've met lately in the industry and their educational backgrounds, the amount of reading they're doing, the amount of communicating they do with each other. I think the trends are on side. Now, this particular question was asking about fee financial planning. And I think by that, what they probably meant was, I'm going to pay a flat fee. Let's say I write a check for $2,700 or $4,000, and I'm going to get an unbiased financial plan because the person's not affiliated with product sales in any way. It's going to be a one-off. So, I mean, I may go back for an annual review or every couple of years for a review. It's a good idea for a lot of people. A lot of younger people whose situations aren't too complex can probably just follow the Wealthy Barber and they'll be fine. But as people get older, they may need more advice. Situations get more complicated. They have more wealth. They have a blended family. They have a business. They've got a holdco, all kinds of things that you say, you know what? I'm at a point now. I want to make sure I'm on the right path, that I'm doing all of this in the best possible way. I'm optimizing, to use that overused word. And you go to some of the fee-only financial planners. Most of them who we've crossed paths with in the last few years have been impressive. I have to be honest, I've seen some of these plans and gone, holy smokes. And I'm fairly tough to impress on that front. I really am. And I look at them and go, these are well done. They're very balanced. They're very thorough. We're seeing a trend in Canada now that we saw a lot in the States 10 years ago. And I think it'll take over up here, where people are specializing often by either a demographic. Let's say I'm only helping people within 5 years of retirement. and I'm helping them get ready. Or they're in retirement, I'm helping them to optimize their retirement income on an after-tax basis. Or by profession, I'm only helping doctors. I'm only helping teachers. And so these fee only financial planners get tremendous specialist knowledge by working on the same kind of account over and over again. So I think the trends in that industry are very, very positive. And I think you're going to see more Canadians using it. But also the typical asset under management model that we see, I call it the Carolina model, where again, they tend to deal with the more wealthy individuals. And they charge, let's say, 80 basis points or 0.8% or 1% a year. A lot of them are very strong too. But to add the full value, they really need to be dealing with people with a fair amount of money who have some more complicated situations. The average person may not end up going that route. So there are some good trends out there. And then the counter trend, obviously, is the people who walk in, obviously, and get advice where it's just, hey, buy this mutual fund. And they aren't even asked ahead of time, do you have credit card debt you should be focusing on first? Do you have a group RSP with a match that you should be focusing on first? We still see some of that too. So there are some negatives, but the trends I'm seeing lately, I've actually been impressed with.
Well, that's exciting and also leaves us on a very hopeful note. It sounds like there are just some red flags that you might want to look out for.
Yeah, always. And I mean, remember, nobody cares as much about your money as you do, not even the wealthy barber. Okay. So you still have to take some responsibility. But as I said earlier, it's not as tricky as you think. It really isn't. In fact, a lot of people I find they'll read the wealthy barber and they'll say, I actually really enjoyed it learning about that stuff. For years, I thought I couldn't get it, but it's not that tricky. And it really isn't that tricky. Now, doing it again, you have to come up against human nature and high costs, but understanding it is not that tough. I mean, you've read the book, there's nothing in there that's that complicated.
It's a great read, you're right. It's very motivating. I've read other personal finance books that, they can provide a lot of great knowledge, but this is one of those books that after each chapter, you're going to put your phone down, you're going to do some Googling, you're going to try to figure out how you can make David's advice work for you. Highly recommend it. If you don't have it, please grab it. David, I cannot thank you enough for joining us today and sharing your wealth of knowledge, no pun intended.
No, I enjoyed it immensely. And now that I'm trapped in my home for probably months, anybody out there watching, just feel free to call me. Like, I mean, I'm just going to be sitting here anyway. So just give me a call. Anyway, I really did enjoy it. Thank you so much for having me. The star was great to work with on this project, by the way, like incredibly professional, but as importantly, everybody was so nice. And so really enjoyed putting this together and hopefully we'll do it again at some point.
That would be amazing. Such a great time today. Thank you, David. Really appreciate it.
Thank you.
Take care.